Welcome back, everyone, to The Deep Dive. This is your intellectual home, the place where we really try to unpack complex topics, cut through all that noise and information overload, and hopefully turn it into some genuine, actionable insights for you. Think of this as a space where curiosity is always rewarded. We're really thrilled to have you joining us again for another journey into the fascinating world of knowledge. Today, we're diving headfirst, really plunging right into a topic that affects, I think, pretty much everyone who's ever made a financial decision. And maybe, let's be honest, thought they knew a little bit more than they actually did at the time. We're exploring the Dunning-Kruger effect in investing. Are you as smart as you think? And crucially, we're going to try and connect this all to the experiences and the unique landscape facing younger investors today. You know, Gen Z. Just think about this for a second. What if your biggest obstacle to financial success isn't really market volatility or, economic downturns? What if it's something far more internal? Something inside you, your own perception of your abilities?
It's a question that can be a little uncomfortable, right, to sort of confront that. But it's also incredibly illuminating, potentially. We've gathered some truly eye-opening research for this deep dive, stuff that suggests our own psychology can sometimes be our worst enemy in the world of investing. Or perhaps, if we understand it properly, maybe our greatest ally.
Indeed. That's really the core of behavioral finance, isn't it? It consistently shows us that even decisions that seem completely rational on the surface, well, they're often influenced by these predictable psychological errors, these biases. It's not just about what you know, though that's important. It's really about how you process that information, how you apply that knowledge, and maybe most importantly, the confidence you actually place in it. And for our younger listeners, especially Gen Z, navigating this really fast-paced, often unfiltered digital investment landscape, understanding these biases isn't just helpful, it's pretty critical.
Right. So our mission today is pretty clear then. We want to equip you with the knowledge to recognize these psychological pitfalls, maybe see them in your own behavior, to understand their deep, often hidden impact. And then crucially, arm you with some practical strategies, things you can actually use. The goal here, simple, really, to help you make smarter, more informed financial choices and, achieve true financial well-being in the long run. Get ready for some hopefully profound aha moments today, things that could genuinely change your financial game, not just now, but for years to come. Okay, so let's jump right into it. Section 1. What is the Dunning-Kruger effect and how does it relate to this broader idea of overconfidence in investing? First off, let's define it. The Dunning-Kruger effect. You've probably heard the term, maybe seen it used online. At its core, it's a cognitive bias where people with low ability at a specific task, could be anything, really tend to overestimate their own ability, sometimes dramatically. Now, there's a flip side too, though it gets less attention. High-ability individuals might slightly underestimate their competence.
Right. They might think, oh, this is easy for me, so it must be easy for everyone.
Exactly. But the real danger, especially when we're talking about money and investing, lies in that first part. The low-skill, high-confidence quadrant. Where did this idea come from? Well, the theory was developed by two psychologists, David Dunning and Justin Kruger, back in 1999. And they explained this paradox quite elegantly. But simply, poorly skilled individuals often lack the metacognitive ability to recognize their own incompetence.
Metacognition, that's basically thinking about your own thinking, right? Assessing your own understanding.
Precisely. So if you're not very good at something, you're also often not very good at realizing you're not good at it. It's that classic unskilled and unaware paradox. These individuals, they don't just make more mistakes, they're also less capable of recognizing those mistakes. And as you can imagine, that leads to this inflated sense of confidence, way more confidence than is actually warranted.
Which can be really dangerous territory.
Absolutely. So the big question for us today, how does this very human, maybe slightly unsettling phenomenon play out when we're dealing with something as complex, as uncertain as financial markets? Picking stocks, predicting market movements, timing the next big thing. What does Dunning-Kruger mean for your investments?
Well, that's where it gets really fascinating and frankly quite relevant to almost everyone. The Dunning-Kruger effect, as you've just laid out so well, it's really just one piece, albeit a significant one, of a much broader issue. The issue of overconfidence that plagues so many investors. What's consistently surprising in the research is just how reliably people overestimate what they actually know. And this isn't just a minor thing. It's particularly pronounced in genuinely difficult tasks, like investment selection, where outcomes are, highly uncertain, dependent on so many variables you can't control. Now, you combine that overestimation of knowledge with its dangerous companion, the tendency to underestimate the actual risks involved, that combination right there is a potent recipe for financial trouble. And then there's this other related bias, the illusion of control. This is that psychological quirk where we believe we have more influence over outcomes than we actually do. Think about a simple coin toss. Studies have shown people will bet more money if the coin hasn't been tossed yet. It's almost like they feel their involvement, their choice, will somehow affect the outcome.
Even though it's pure chance.
Exactly. The coin doesn't care who's betting. And this illusion stretches right into investing. Investors often believe, quite irrationally, that the stocks they personally own will perform better than other stocks. Just the act of ownership creates this illusion of control, even if they have no special information. It's like, well, I picked it, so it must be good.
That's a powerful feeling, though.
It is. Now, this broader overconfidence often shows up in two specific ways, two faces, if you like. The first is miscalibration. This means your probability estimates are just too tight, too narrow. Let me give you an example. Researchers ask people factual questions, things like, what was the population of Poland in 2010? Or how many books were in the Library of Congress in 2016? And they ask for a 90% confidence range. So a range you're 90% sure contains the true answer.
Okay, so you should get about 9 out of 10 right if you're well calibrated.
Precisely. But what happens, most people miss 5 or more out of 10. Their ranges are way too narrow. It shows we're often far too certain, even when we have little or no real information. And get this, even finance professors, people who teach this stuff, often miss at least 5. It's incredibly pervasive.
Wow. So even the experts aren't immune.
Not at all. The Blinkist takeaway here. Don't just guess an answer. Guess how certain you are, and then probably widen that range. You're likely more overconfident than you realize. The second face of overconfidence is the better-than-average effect. This is a deeply ingrained human tendency. We tend to hold unrealistically positive views of our own abilities, our knowledge, our skills, compared to the average person.
Oh, yes, the driving example.
Exactly. The classic anecdote, a study found something like 82% of college students rated themselves as above-average drivers.
Which is mathematically impossible, of course.
Right. Only 50% can be above the median. It clearly shows many of us are just fundamentally mistaken about where we stand relative to our peers. And this flawed self-assessment has huge implications for how we approach something competitive and high stakes like investing.
So the punchy insight. Most of us think we're smarter, better investors than average. But mathematically, that can't be true for everyone.
Precisely. Approach investing with a healthy dose of skepticism about your own perceived genius.
Okay, that's a really crucial foundation. These biases aren't just abstract concepts. They actually drive behavior, often costly behavior. So if we're all walking around thinking we're investment whizzes, thanks to Dunning-Kruger or just general overconfidence, what does that actually do to our portfolios? How does it manifest? Let's talk about overconfident trading and its consequences. This is probably the most direct hit to the wallet. And interestingly, research has found some gender differences here. Studies often show men tend to be more overconfident than women, particularly in tasks perceived as masculine domains. And managing finances historically has often been seen that way.
Right. Rightly or wrongly.
And this translates into observable behavior. Male investors often trade more frequently than female investors. There's a landmark study on this by Brad Barber and Terence O'Dean. They looked at, nearly 38,000 households using a large discount brokerage back in the 90s, from 91 to 97. They looked at trading levels using something called turnover.
Turnover is basically how much of your portfolio you buy and sell over a year, right?
Exactly. A 50% turnover means you sold half your stocks and bought new ones. 100% means you replaced the whole portfolio. 200% means you did that twice. They split investors into 5 groups based on turnover, and the results were pretty stark. The group at the highest turnover, trading more than 250% of their portfolio annually, they significantly underperformed the market by quite a bit, actually.
So more trading equaled worse results.
That was the strong implication. Now, this study used trading volume as a proxy for overconfidence. They didn't directly measure the confidence itself, but the link seemed very clear. The takeaway: frequent trading, often fueled by thinking you know better than the market, is generally a losing game. Less tinkering is often more profitable, and researchers wanted to nail this down further. They conducted follow-up studies trying to measure overconfidence directly. For example, Marcus Glaser and Martin Weber studied investors at an online German brokerage. They surveyed them, asking questions like, what percentage of other customers do you think have better skills than you at picking stocks? Trying to gauge that better-than-average effect.
And what did they find? Did the confident ones actually do better?
That's the crucial part. They found zero correlation between the investor's self-assessed skills and their actual past performance.
Wow. So thinking you were good didn't make you good.
Not at all. But they did find a positive correlation between that better-than-average measure of overconfidence and trading volume.
Ah, so the overconfident ones did trade more.
Exactly. It directly confirmed the link. Overconfident investors, despite lacking superior skill, traded more actively, which, based on the earlier Barber and Odin study, likely hurt their returns.
So don't mistake activity for progress. Believing you're better doesn't help your portfolio. It just makes you trade more, and that usually costs you money in commissions and poor timing. That link between belief and action is so critical. And this overconfident trading, it's often supercharged by another modern problem, especially relevant for Gen Z information overload. It sounds counterintuitive, doesn't it? But getting more information, even if it's potentially valuable, can increase your confidence much, much faster than it increases your actual accuracy.
That seems dangerous.
It is. There was an experiment with predicting college football games. Participants got statistical info in chunks to predict outcomes and point spreads. Then they rated their confidence. As they got more info, their confidence shot up really quickly. But their prediction accuracy, it improved only marginally, sometimes not at all.
So they felt smarter but weren't actually making better predictions.
Precisely. The core insight is crucial. More data often boosts confidence far more than accuracy. So, pause before you hit buy or sell. Ask yourself, am I truly more accurate now? Or do I just feel more certain because I read 3 more articles? And this is so relevant for today's individual investors, especially younger ones, Gen Z, constantly turning to the internet. Scrolling through analyst recommendations, reading news groups, hanging out in chat rooms or on Reddit forums like Wall Street Bets.
Right, there's just endless information out there.
Endless and often unfiltered. While investors might feel their knowledge has dramatically increased from consuming all this, the reality is often quite different. For instance, studies looking at message board postings like on ragingbull.com back in the day found that positive posts about a stock were not associated with positive returns the next day or week. The hype didn't predict performance.
But did it affect trading?
Yes. Unusually high numbers of postings were associated with higher trading volume. It suggests that overconfidence, fueled by this perceived but often useless information, was driving the trading activity. People felt informed, got confident, and traded more. And the sheer ease of online trading just pours gasoline on this fire. Remember the Barber and Odin follow-up. Investors who switched from phone-based brokers to internet trading immediately saw their portfolio turnover jump significantly, like from 70% to 120% annually. And it stayed high, around 90%, even 2 years later.
Just removing that little bit of friction made a huge difference.
A huge difference. It makes it easier for overconfidence, stoked by readily available but often low-quality information, to translate into excessive, costly trading. So for Gen Z getting investment tips from TikTok or Discord servers, remember, perceived knowledge from social media rarely translates into actual market outperformance, but it will likely make you trade more. Be incredibly critical of your sources.
That ease of trading, that illusion of knowledge, fueled by information overload, it really does create the perfect storm for speculative bubbles, doesn't it?
Yeah.
And we have such a classic, almost unbelievable real-world example, the dot-com bubble of the late 1990s. Do you remember that? Or maybe for younger listeners, your parents do. When simply adding .com or internet to a company's name could make its stock price explode.
Oh, absolutely. It was madness, pure mania.
It really was. There's research showing that between mid-1998 and mid-1999, 147 publicly traded companies actually did this. Changed their names to include .com or .net or just the word internet. And the market reaction was instantaneous and massive. In the 3 weeks right after announcing the name change, these companies' stocks, on average, beat the overall market by a staggering 38%.
38% just for a name change.
Right. And get this. Even firms with little or no actual internet experience companies, whose core business was something totally unrelated, with no evidence they could succeed online, they saw their stock prices bid up so high they beat the market by 48%.
It didn't matter what they actually did. The name was enough.
Exactly. It was all about the label. Investors were just throwing money at anything that sounded like the internet. These huge gains lasted for months. And then, of course, the bubble burst spectacularly in 2000. And here's the kicker. After 2000, 67 companies actually removed .com from their names. And doing that was associated with an average 64% return in the following 2 months.
So the market rewarded them for taking it off. It completely reversed.
Completely. It's like the market suddenly sobered up. This just perfectly highlights how investors, often driven by excitement, hype, And a superficial sense of familiarity rather than any deep understanding can be swayed by purely cosmetic changes. It leads to massive overvaluation and then, inevitably, painful crashes.
A powerful lesson.
Absolutely. For today's new investors, especially Gen Z facing the next wave of trendy assets or tech themes, there's a critical historical lesson. Don't fall for the modern equivalent of the dot-com effect just because something is popular or has a cool name. Look deeper.
That dot-com example is just such a stark illustration of collective overconfidence, herd behavior, and superficial judgment. And you're right, these biases rarely work in isolation. Beyond Dunning-Kruger and general overconfidence, several other behavioral traps profoundly influence how we invest. One of the most pervasive, especially in our fast-paced, instant gratification world, is myopia. Financial myopia. This refers to essentially short-sightedness in economic and financial decisions. Myopic individuals show extreme short-time preferences. They prioritize immediate rewards, short-term gains over greater, often significantly larger long-term benefits.
So wanting the marshmallow now instead of two later.
Exactly that kind of thinking applied to finance. This bias also leads to focusing too much on immediate surroundings or recent events when making decisions, and it's strongly linked to underestimating long-term risks. We see the damaging effects of myopia across the board in investment choices, insurance decisions, retirement planning, critical areas. Think about that classic time preference experiment. Most people, if offered $50 right now or $100 in 2 years, will take the $50 now.
Even though waiting means doubling their money, a 41% annual return.
Right, but here's the interesting part. If you offer the same choice, shifted into the future, $50 in 4 years or $100 in 6 years, almost no one takes the $50.
It's the same 2-year wait for double the money, just further out.
Exactly. It shows how our present bias distorts our perception of value over time. Immediate rewards feel disproportionately attractive compared to future ones, even if the future reward is objectively much better. And the financial media, frankly, often makes this worse.
How so?
By constantly focusing on daily market swings, quarterly earnings, the latest headline, they rarely frame information in a broader long-term context. This relentless drumbeat of short-term news encourages a trader mentality, react now, rather than a patient long-term investor mindset.
So it feeds that myopia.
It absolutely can. The bottom line on myopia, our brains are wired for now. Long-term gains feel abstract, less real. We have to consciously fight this by framing decisions in terms of our future goals, future freedom, future security, not just today's potential profit or loss. There was a particularly vivid, maybe even chilling example of this short-term focus from an interview on PBS's Frontline, a woman named Sharon. She had invested her family's entire life savings into just 2 tiny technology stocks, and most of it was in one single firm. And she openly admitted, quote, "To tell you the truth, I don't even know the name of it. I know the call letters are AMLN. It's supposed to double by August."
Wow. That's breathtakingly risky.
Yeah.
And based purely on a short-term hope.
Exactly. Extreme short-term focus, zero fundamental research, complete lack of diversification, betting the entire family savings on a ticker symbol she barely knew just because she heard it was supposed to double soon. That's myopia in its most dangerous form.
Sharon's story is a really stark reminder of how devastating that kind of thinking can be, especially when combined with other biases. And you're right, myopia rarely travels alone. It often teams up with other troublesome mental shortcuts, doesn't it? Let's talk about how representativeness and familiarity biases can lead us astray together. Representativeness bias. That's when we make predictions based on stereotypes, right? How well something matches a pattern we think we recognize, even if it's statistically unlikely.
Precisely. Like judging a book by its cover, but with investments.
In investing, this often leads people to confuse a good company with a good investment. We see a company with strong earnings, high sales growth, maybe a well-known brand, and we think that must be a great stock to buy.
It seems representative of a successful investment.
Exactly. But a good investment is one whose stock price goes up more than others. And often, those good companies are already well-known, their virtues priced in. They can become overvalued precisely because everyone recognizes they're good.
Leading to future underperformance. It's an overreaction to the positive story.
Right. So the good company isn't always the good stock to buy now. And a really common subset of representativeness, something we see all the time, is extrapolation bias, or as it's often called, chasing winners.
Buying what's already gone up a lot.
Exactly. Investors mistakenly assume that recent past performance will continue into the future. If a stock or a fund did great last year, they assume it'll do great next year. We see this clearly in mutual fund flows. Study after study shows investors tend to pour money into the stock market after it's had a strong run near the peaks. Think late 90s tech bubble again. Billions flowed in right at the top. Then, after the crash in late 2002, early 2003, when stocks were cheap, they started pulling money out.
Buying high and selling low, the classic mistake.
Consistently. The same pattern happened around the 2008-2009 crisis. Money flowed out at the bottom, missing the recovery. By the time a trend is clear enough to extrapolate, you've often missed the best part of the move. It's a recipe for underperformance.
The hard truth. Don't blindly chase last year's winners. Past performance is genuinely a terrible predictor of future returns in most cases. What goes up doesn't always keep going up.
Then there's familiarity bias, sometimes called home bias. This is our natural inclination to invest in what we know, what feels comfortable.
Which sounds sensible, but actually hurts diversification.
Hugely. Investors tend to over-allocate to companies from their own country. That's the classic home bias. But it goes further. They overweight local firms, companies headquartered nearby. And, perhaps most dangerously, they often put far too much money into their employer's stock in their retirement plans.
Believing it's safer because they know the company.
Right. They mistakenly think familiarity equals safety or superior returns. Research even shows professional money managers who should know better tilt their portfolios towards local, smaller, often riskier firms headquartered near their offices.
Really, even the pros do it.
They do. This only game in town effect, where local investors concentrate on local stocks, can even distort prices. Firms in regions with fewer public companies might become overpriced just because the local investor base is piling in. Small, less visible regional firms are most affected.
Think globally.
Globally, countries where investors show a stronger home bias tend to have higher domestic market returns, which sounds good, but it actually indicates a higher cost of capital for firms in those countries because they're not attracting a diverse pool of international investment. They have to offer higher returns to compensate for the concentrated ownership. So that comfort zone in investing, it can actually be your biggest risk zone. Familiarity is not safety. True diversification, often into the unfamiliar, is much safer. And what's really worrying is how these biases can compound, feed off each other. Think about employees in a 401k. They often combine familiarity bias, I know my company, with representativeness bias. The stock price has gone up recently, so it must be a good investment.
So they buy more company stock after it's already risen.
Exactly.
Yeah.
Doubling down on the concentration risk, driven by extrapolation and familiarity. Despite research showing absolute no evidence that firms with high employee ownership perform any better.
It's a double whammy of bias leading to potentially disastrous concentration. It truly is. Our minds are masters at finding comfort in the familiar, even when it's financially detrimental. Building on that emotional aspect, another incredibly pervasive bias that directly drives buy-sell decisions is the disposition effect. This describes how investors, often unconsciously, are driven by the fear of regret and the simultaneous desire for pride. This leads them to sell winning investments too early, locking in that feeling of pride. And, conversely, hold on to losing investments for far too long, avoiding the pain and regret of admitting a mistake.
The classic cut your flowers and water your weeds mistake.
Precisely. Imagine you own two stocks. Stock A is up 20%, stock B is down 20%. The disposition effect predicts you'll feel a strong urge to sell stock A, yay, I made money, let's lock it in, and a strong reluctance to sell stock B. Ouch, I don't want to make that loss real, maybe it'll come back.
And does the trading data back this up?
Absolutely. Studies examining trading volumes after price changes consistently find this pattern. High trading volume for stocks that have recently gone up, suggesting investors are quick to sell winners. And low volume for stocks that have gone down, indicating investors are stubbornly holding on to their losers. This behavior is so strong it even persists in December, when tax loss harvesting would actually provide a financial benefit for selling losers. The emotional drive to avoid regret often overrides the rational financial incentive.
Wow. Pride and regret are powerful motivators.
Incredibly powerful. The key insight here, you have to actively fight that natural urge. Sometimes the smartest move is to cut your losses decisively and let your winners continue to run, not the other way around. This behavior is also tied to how we adjust our mental benchmarks, something called reference point adaptation. For winning stocks, investors tend to adapt their reference point upwards. If a stock they bought at $100 goes to $150, they feel good, maybe sell to lock in the pride. Or they might mentally reset their baseline to $150, so any further gain feels like a new win.
So they're quick to feel happy about gains.
Yes. But for losers, they don't adapt the reference point. If that stock bought at $100 drops to $50, they stubbornly cling to the original $100 purchase price as their benchmark. Selling at $50 would mean implicitly locking in the sadness, the regret of that $50 loss relative to their fixed reference point.
So they hold on, hoping to get back to break even.
Exactly. It explains why gains are often realized quickly, but losses are held onto, sometimes indefinitely. And this reluctance to realize losses, this holding on to mistakes, creates cognitive dissonance. That uncomfortable mental tension when your beliefs, I'm a smart investor, clash with reality. This stock I picked is down 50%.
How do people resolve that tension?
One common way is to blame someone else. This shows up really clearly when comparing direct stock trades versus mutual fund investments. Investors are much less reluctant to sell a losing mutual fund. Why? Because they can blame the portfolio manager. That manager didn't know what they were doing. This is sometimes called a reverse disposition effect.
So offloading the blame makes it easier to cut the loss.
Precisely. But for direct stock trades, where they made the decision, the disposition effect is much stronger. They have to own the mistake, which is painful, so they avoid it by holding on. Even the language used matters. Framing the decision as hiring or firing a mutual fund manager can actually increase this reverse disposition effect, making the delegation aspect, and thus the ability to shift blame, more salient.
Fascinating. It's easier to part with a loser if you don't feel personally responsible for picking it. It's just incredible how our minds work overtime to rationalize these things, isn't it? Constantly managing emotions like pride and pain. And our attitude towards risk itself isn't fixed either. It shifts based on recent experiences, and it's heavily influenced by this concept called mental accounting. People don't just have one set level of risk aversion. It changes, sometimes dramatically, based on whether they've just won or lost.
Right. There are a few related effects here.
Yeah, like the house money effect. After you've made some gains, you feel like you're playing with the casino's money, right?
Yeah.
So you become willing to take more risk. The winnings don't feel like your own capital anymore.
Exactly. And the opposite can happen after losses. The snakebite effect makes people much less willing to take risks. They've been burned, so they become overly cautious, maybe missing good opportunities.
But sometimes, after a loss, especially a small one, people do the opposite, right? They take more risk.
Yes, that's the trying to break even effect. If you're down a bit, you might feel tempted to make a bigger, riskier bet to try and quickly recoup that loss and get back to your starting point. It's often driven by that same desire to avoid realizing the loss.
You can actually see these shifts play out really clearly on game shows, like Deal or No Deal.
Oh, that's a perfect example.
Right. Contestants' willingness to take the bank's offer versus playing on, taking huge gambles, it changes dramatically based on the last few briefcases they opened. If they've just eliminated low-value cases, they feel like they're playing with house money, they get bolder. If they've just knocked out the big million-dollar prize, suddenly they might get much more risk-averse or maybe take a desperate gamble to try and get back what they feel they lost. It's pure emotion and recent outcomes driving risk tolerance. And beyond these shifting risk appetites, this idea of mental accounting plays a huge, often invisible role in our financial lives. This is the tendency to treat different pools of money differently, even though money is fungible, a dollar is a dollar.
We put money into different mental buckets.
Exactly. Like, think about a windfall, a bonus, a tax refund, an inheritance. People are much more likely to save that money compared to an equivalent amount from their regular paycheck.
Why is that?
Because the windfall often goes into a mental wealth account, a sort of special money bucket. The paycheck goes into the consumption account, mentally earmarked for bills and everyday spending. It just feels harder to save money that's already mentally assigned to spending.
And this has real consequences.
Huge consequences. For example, policy changes that shifted tax payments so people got smaller refunds but slightly bigger paychecks actually led to a significant reduction in IRA savings for many individuals. Same total income, but because it arrived via the paycheck, consumption account instead of a refund wealth account, less got saved.
That's amazing. Just framing it differently changed behavior.
Right. The simple insight. A dollar is a dollar. Try to treat all your money with the same strategic intent, regardless of where it came from or what mental label you've attached to it. Mental accounting also really messes up portfolio construction. Instead of looking at their overall portfolio as one integrated whole, like modern finance theory tells us to, most investors put each investment into its own separate mental account.
Like, here's my safe bond money. Here's my risky tech stock money.
Exactly. And by doing that, they completely ignore the crucial interactions, the correlations between those investments, how they move together or offset each other. That's the whole point of diversification. This often leads people to build portfolios like pyramids, layer by layer. They match their risk tolerance to each individual component rather than the overall risk of the total portfolio.
Which isn't optimal at all.
Not at all. A common result is naive diversification, especially in 401k plans. It's called the 1N rule. Employees just spread their contributions evenly across however many funds are offered. 10 funds, 10% in each. 5 funds, 20% in each, regardless of whether those funds are high risk, low risk, or highly correlated.
So the number of options dictates the allocation, not the investment characteristics.
Precisely. And related to that, many employees still consider their own company stock to be safer than a diversified mutual fund, despite all the historical examples like Enron where employees lost both their jobs and their retirement savings.
That familiarity bias again.
Compounded by mental accounting. This fragmented view, treating each investment in isolation, completely undermines prudent risk management and optimal long-term wealth building. The goal should be one cohesive, diversified portfolio, not just a collection of separate mental bets. Break down those walls between your mental accounts.
So we've covered a lot of these biases. Dunning-Kruger, overconfidence, myopia, representativeness, the disposition effect. It really makes you wonder, where does all this come from? Is it just stuff we learn, bad habits we pick up? Or is there something deeper, maybe even biological, going on? The answer, based on some really fascinating research, seems to be, well, it's both. Nature and nurture. Let's start with the nature part, the potential role of genetics. Twin studies, especially some large-scale ones out of Sweden, have provided really compelling evidence here.
How do twin studies help with this?
Well, by comparing identical twins who share 100% of their genes with fraternal twins who share about 50% like regular siblings, researchers can estimate how much of the variation in a trait, like financial risk-taking, is due to genetics versus environment.
Okay, makes sense. What did they find?
Pretty remarkable stuff. These studies suggest a significant genetic component to financial risk aversion. One study found that genetics explained about 28% of the variation in the level of risk people took in their pension investment decisions.
Wow, over a quarter attributed to genes.
Yes. And even more striking, for certain biased behaviors, like chasing high-return funds, that extrapolation bias we talked about genetics was estimated to account for over 30% of the tendency.
So the tendency to chase winners might be partly hardwired.
It appears so for some people. Now, it's not just about risk appetite. Adoption studies add another layer. These studies, again in places like Sweden, but also comparing Korean adoptees in Norway, help disentangle genetic influences from biological parents and environmental influences from adoptive parents.
What do they show? Both matter.
Both definitely matter. The adoptive parent's environment seems to have a greater impact on whether someone participates in the stock market, and the overall risk level they take, the adoptive effect, was about 4 times larger than the biological effect for risk level. But genetics still plays a clear role. It accounted for about 14% of stock market participation likelihood and roughly 1/3 of the variation in wealth acquisition, even after accounting for environmental factors.
So genes give you a predisposition, but environment shapes how it plays out.
That seems to be a reasonable interpretation. Some of us might be naturally wired to be more risk-seeking, more prone to certain biases,
Sure.
which means those individuals have to be extra aware of these innate tendencies and maybe put more deliberate safeguards in place. Researchers are even starting to identify specific genes that might be involved. One fascinating candidate is variation in the DRD4 gene, specifically the 7-repeat allele.
What does that gene do?
DRD4 is involved in dopamine signaling in the brain. Dopamine is key for reward and motivation. This specific 7-repeat allele is linked to reduced sensitivity to dopamine. Basically, individuals with this variant might need more stimulation, more excitement to feel the same level of reward or satisfaction.
And how does that relate to finance?
Well, studies have linked the 7-repeat allele to increased novelty-seeking behavior and even compulsive gambling. This directly impacts financial decision-making, potentially leading to less patient choices, a preference for riskier, more speculative investments, things that provide that bigger dopamine hit they might biologically crave. It suggests a potential neurobiological drive towards thrill-seeking in finance for some individuals.
That is genuinely mind-blowing. To think that our investment choices could be influenced, even partially, by our specific genetic code, by our dopamine receptors. But as you said, it's nature and nurture. Environment plays a huge role too, which is maybe more empowering because we can influence our environment and our learning. This brings us right to the critical importance of financial literacy education. Now, financial literacy. The OECD defines it pretty comprehensively as a combination of awareness, knowledge, skill, attitude, and behavior necessary to make sound financial decisions and ultimately achieve individual financial well-being.
It's more than just knowing definitions.
Much more. And the consequences of poor financial literacy are really severe. It's linked to bad financial choices, high levels of debt, vulnerability to financial fraud, low savings rates, even just difficulty processing basic financial information. But here's the crucial distinction, the part that connects back to all these biases. How financial education is delivered makes a huge difference. Traditional financial education mostly focuses on the what. What is compound interest? What is a stock? What is diversification? It's like learning the vocabulary.
Giving people the information.
Right. But behavioral-based financial education shifts the focus to the how. How do you make good decisions in practice? How do you recognize and counteract biases like myopia or overconfidence when you're actually faced with a choice?
So it integrates the psychology?
Exactly. And research shows this behavioral approach can have significant indirect effects on improving financial literacy, precisely because it increases awareness of these biases. People become more literate overall because they understand the pitfalls in their own thinking, these indirect effects. They're largely absent in traditional, purely informational courses.
That's a really key finding.
It really is. The profound insight here. Just giving people facts isn't enough. We need to teach critical thinking, self-awareness, how to recognize and manage our inherent psychological tendencies. That's what truly improves financial decision-making. It's about building wisdom, not just knowledge.
And this process of learning and managing biases isn't static across our lives, which really underscores why building these skills early is so vital. We also need to consider the dynamic interplay between cognitive aging and investment experience. It's a fairly well-established finding in psychology that, on average, certain cognitive abilities tend to decline as we age, things like processing speeds, certain types of memory.
That's a bit depressing. How does it affect finances?
It can have a real impact on financial risk attitudes. For example, research suggests that much of the increase in risk aversion often observed in older adults isn't just because their financial needs are changing, like needing safer income in retirement. A significant part is actually due to cognitive aging itself. Slower processing might make complex or risky choices feel more daunting.
So our brains might naturally make us more cautious as we age, sometimes maybe too cautious.
That's the potential downside, yes. We might miss out on appropriate growth opportunities. However, there's an upside. Investment experience gained over decades can act as a powerful counterbalance. Accumulated knowledge, familiarity with market cycles, having learned from past mistakes, this experience can help offset some of the negative impacts of cognitive aging on financial decision-making. There was a large study looking at over 62,000 investor accounts at a U.S. brokerage. They used the investor's age as a rough proxy for cognitive ability. Older, potentially lower ability on average, and the time the account had been open as a proxy for experience.
What did they find? Does experience win out?
It's a balance. They examined how age and experience interact to influence actual investment performance, trading frequency, and diversification levels. The findings suggest that while cognitive decline is a factor, accumulated experience can indeed help investors navigate market complexities more effectively later in life. It helps moderate the impact of those age-related cognitive shifts.
So for Gen Z, the takeaway is...
Start building good habits now. Gain experience purposefully. Learn from your early mistakes, hopefully small ones. That accumulated knowledge and experiential wisdom will be invaluable later on, providing a buffer against the natural effects of cognitive aging and ensuring a more resilient financial journey throughout your entire life.
These insights into the roots of our biases, nature, nurture, aging, experience, they're absolutely critical, especially when we think about the generation just starting their investment journeys. And that leads us perfectly into our next section, behavioral financial education and Gen Z, a path to better decisions. There was a really groundbreaking study, quite relevant here, conducted among 14 to 18-year-old secondary school students in the Flemish region of Belgium. These students are basically a direct analog for the Gen Z investors just entering the scene. They're on the cusp of adulthood, about to face real financial decisions, first jobs, maybe student loans, maybe opening their first investment accounts.
So a really crucial age group to understand.
Exactly. And this study tried something quite novel and incredibly relevant for how Gen Z learns. They used engaging, self-guided online courses. The core question was, is teaching these kids how to recognize their own biases, specifically myopia or short-sightedness, more effective than just giving them traditional finance lessons?
Using the kind of online tools they're used to.
Precisely. The courses had adaptive assistance, personal feedback mirroring modern e-learning. The curriculum covered the essentials: financial planning, managing money, risk, and reward. But here's the key. They had different groups. One got traditional financial education, the what, Two other groups got content specifically focused on understanding and countering myopic bias, the how, with one of those courses being longer and more intensive.
So they could compare the approaches directly.
Right, and they measured the outcomes carefully. Pre- and post-tests assessed financial literacy looking at knowledge, attitudes, and behavior. They also directly measured myopic bias and other biases like overconfidence. The questions were really practical, understanding inflation, compound interest, diversification, but also things like time preference for pensions, underestimating insurance risks, and even identifying dodgy investment ads. It gave a really rich picture.
Sounds like a very thorough experiment.
It was. The big takeaway here, this wasn't just theory, it was a real-world test to see if we could effectively inoculate young investors against some of their own worst psychological instincts. And the results, frankly, they were quite encouraging.
They really were. The findings from this Flemish school experiment offer some genuinely promising insights, especially for guiding young investors. First, the baseline good news. Both the traditional and the behavioral courses improved financial literacy overall. So, education works.
Okay, that's good to know. But was the behavioral approach better?
Yes, that's the key distinction. The real aha moment from the study. The behavioral-based courses, particularly the longer, more intensive one focusing on myopia, showed the highest effect size in improving overall financial literacy. And crucially, they were also the most effective at actually reducing the students' myopic bias itself.
So tackling the bias directly made them more financially literate overall.
Exactly. It strongly highlights the value of focusing on how to make good decisions by explicitly addressing these psychological pitfalls, rather than just focusing on what financial concepts to learn. It's about building those mental frameworks, that self-awareness. The study also dug into who benefited most, offering clues for targeted interventions. For students who started out with a high level of myopic bias, the ones most prone to short-sightedness, the longest behavioral course had the greatest positive impact.
Suggesting that for those most at risk, a deeper dive is needed.
Precisely. A more extensive behavioral intervention seems necessary to make a really significant, lasting difference for those individuals. Demographically, older students, 17-18, generally showed slightly larger improvements, which makes sense. Perhaps they saw the relevance more immediately. But importantly, the intensive behavioral course still showed strong positive effects across all the age groups studied. And interestingly, there was a finding that females tended to benefit more from the behavioral interventions in terms of improving their financial literacy scores.
Any theories why?
The study didn't definitively say, but it could suggest gender-specific impacts or maybe a greater receptiveness among the female students in this cohort to these particular teaching methods focusing on self-reflection and bias awareness. Needs more research, but it's an interesting finding. But perhaps the most profound finding from a research standpoint was the mediation analysis. This statistical technique basically confirmed that the improvement in financial literacy driven by the behavioral courses was significantly explained or mediated by the reduction in myopic bias.
So it proved the causal link. Learning about the bias reduced the bias, and that reduction directly led to better financial literacy.
Exactly. It's not just that financially literate people happen to be less myopic. The education specifically designed to reduce myopia actively built broader financial literacy. It confirms the mechanism.
That is incredibly powerful.
It really is. So for Gen Z, the message is crystal clear. Learning about and actively tackling your own potential biases isn't just some fluffy side project. It's a direct, evidence-based pathway to becoming truly financially savvy and making better decisions. The study rightly calls for more research, of course, developing materials for other biases besides myopia, replicating this in different cultures and contexts. But the core principle seems incredibly strong and universally applicable. Behavioral financial education works.
That confirmation of the causal link is just so empowering, isn't it? It means we genuinely can teach ourselves and teach the next generation to be better, more rational investors. And these findings, they have such direct, profound implications for Gen Z. Those 14 to 18-year-old students in Belgium, that's exactly the demographic entering the investment world right now, often through digital platforms. This is a generation growing up absolutely saturated with information, much of it unfiltered, coming through social media, TikTok, YouTube, Reddit.
Making them potentially very vulnerable to certain biases.
Exactly. Highly susceptible to overconfidence, maybe thinking they found some secret edge from a Discord server. Highly susceptible to representativeness, seeing a meme stock take off, and assuming it's a trend based on nothing fundamental. And the sheer speed and instant gratification nature of digital finance, that can massively exacerbate myopia, that short-term focus. It makes the dot-com bubble or Sharon's story seem almost quaint. The ease of trading on an app, the constant stream of expert opinions, the social validation in online communities. It can amplify these psychological traps dramatically.
It creates a very challenging environment.
It really does. Which means the need for targeted, behavioral-based education for this generation is absolutely paramount. They're the earliest adopters of new financial tech. They're exposed to incredibly diverse and sometimes dangerously misleading information. Building their self-awareness and critical thinking skills around these biases isn't just nice to have, it's essential for their financial future.
Absolutely. And the really good news amidst all this discussion of potentially scary biases is that there are concrete practical strategies we can all use to fight back, to beat these biases, or at least manage them. It's not about achieving perfect rationality that's probably impossible for humans. It's about building systems, both internal and external, that acknowledge our inherent irrationality and steer us towards better outcomes. Let's talk through some foundational strategies. Strategy number 1 is perhaps the most obvious, but also the most critical. Understand the biases. Awareness is truly the first most powerful step. Just recognizing these psychological pitfalls, Dunning-Kruger, myopia, confirmation bias, all of them in yourself, and seeing them in market commentary or others' behavior is critical to avoiding their influence. Honestly, this deep dive we're doing right now, listening to this, that's part of executing this first strategy.
Building that mental toolkit.
Exactly. Second foundational strategy. Know why you are investing. This sounds incredibly basic, right? But you'd be surprised how many investors, even experienced ones, skip this step or have only vague goals. You need to move beyond fuzzy aspirations like, I want to be rich or I want a comfortable retirement. Get specific, quantify your objectives. Instead of, I want to travel abroad in retirement, define it. I want $75,000 per year income in today's dollars during retirement to support 2 major international trips annually. Based on my timeline, this requires accumulating an investment portfolio of $800,000 within the next 10 years.
That's much clearer. How does it help with biases?
Clear, concrete goals provide direction. They anchor you. They act as a vital shield against making emotional, bias-driven decisions when the market inevitably gets choppy or some new speculative frenzy emerges. You can ask, does chasing this hot stock actually align with my goal of funding those retirement trips? Often, the answer is no. Third strategy. Have quantitative investment criteria. This means establishing clear, objective, measurable rules for buying and selling investments before your emotions get involved, before biases like the disposition effect or herd behavior can take hold.
Give me an example.
Okay, maybe. I will only buy stocks with price-to-earnings ratio below 20 and a debt-to-equity ratio below 1. Or, for selling, I will automatically sell any stock if it drops 15% below my purchase price, a stop loss, or if its valuation exceeds X based on my criteria. The specific rules matter less than the fact that you have rules decided upon when you were calm and rational. These rules act as a pre-commitment device, countering emotionally driven choices like holding losers too long or selling winners too soon. It forces logic over feeling. Fourth, and this is crucial, diversify. Truly diversify. Actively fight that familiarity bias, that home bias, and the tendency towards mental accounting. Spread your investments across different asset classes, stocks, bonds, real estate, maybe alternatives, different geographies, U.S., international, developed, emerging markets, and different industries and company sizes. And don't just do naive diversification, that one annual where you put 10% in each of the 10 funds offered in your 401k, regardless of what they are.
Right. Understand the underlying assets and how they correlate.
Exactly. True diversification lowers your overall portfolio risk significantly. It protects you from putting too much faith in one company, like your employer's stock, or one sector, like that tech stock gamble. It's about building a robust portfolio where the components work together, not just a collection of isolated bets in separate mental boxes. And finally, strategy number 5, control your investing environment. This is about actively setting up safeguards for yourself, acknowledging your potential weaknesses. One part is creating rational rules of thumb during calm periods, mental checklists you can rely on during emotional times, things like never invest in something I don't understand, don't touch the principal, stick to the plan during downturns, rebalance regularly. The other part is controlling your actual physical and digital environment to minimize temptations. Well, if you know you're prone to overtrading or reacting emotionally to daily news, maybe don't have stock market apps sending you push notifications all day. Maybe limit how often you check your portfolio. Once a quarter might be enough for long-term investors. Maybe avoid frequenting online forums known for hype and speculation if you find yourself getting sucked in. It's about proactively managing your triggers, exercising self-control by structuring your environment to support your rational goals, not undermine them.
Those foundational strategies are incredibly powerful. Just doing those consistently would put most investors way ahead of the game.
But we can also get a bit more sophisticated, right? We can actively leverage behavioral insights themselves, almost like using psychological jujitsu on ourselves, to design better financial choices. Nudge ourselves in the right direction. One of the most potent tools here is understanding the power of framing. How a choice or information is presented can dramatically change our decisions, even if the underlying facts are the same.
Small changes in presentation, big changes in behavior. Exactly. Think about 401k enrollment. The old way was opt-in. You had to actively sign up. Participation rates were often low, maybe 30–40%. The new way, increasingly common, is automatic enrollment you're in unless you actively opt out. What happens? Participation rates skyrocket, often to 80–90% or more.
Same choice, just a different default. Overcomes inertia and procrastination.
Precisely. Or consider the number of investment options. Sometimes fewer choices are better. Classic jam study analogy. People were more likely to buy jam when presented with 6 choices versus 24. Too many options can lead to overwhelmed decision paralysis. Reducing the number of funds in a pension plan can actually increase participation. Framing the cost of things differently works too. Payday loans often advertise a seemingly small fee, but the APR is astronomical. Studies show that presenting the true dollar cost of that loan over its term, rather than just the confusing APR, significantly reduces how often people reborrow. It makes the cost concrete and easier to understand.
Making the pain salient.
Right. Even for huge decisions like Social Security. Framing the choice around delaying benefits, positively emphasizing the higher monthly income you gain later, tends to lead to better long-term decisions than framing it negatively around losses, from claiming early or complex break-even calculations. Focus on the gain, not the perceived loss. We could also use framing to manage our spending urges. There's a great concept, pay first to play later. It's the antidote to buy now, pay later. Think about prepaying for a vacation months in advance.
How does that help?
Well, the financial pain of paying happens early, long before the pleasure of the trip. By the time you're actually on vacation, the cost is a distant memory. You decouple the pain of paying from the pleasure of consumption, maximizing the enjoyment. You also get the pleasure of anticipation. Compare that to paying off credit card bills for months after the vacation is over. Much less fun. And for those people, maybe some of our listeners, who genuinely get a thrill from investing, who are maybe prone to that sensation-seeking we talked about with the DRD4 gene, instead of trying to completely suppress that urge, which might be futile, a smart strategy is the play account.
Setting aside a small amount for speculation.
Exactly. Define a small, strictly limited portion of your total wealth, say 5% or less, and put it in a separate brokerage account. This is your play money. You can use it to trade more actively, chase trends, buy those speculative stocks, whatever satisfies that itch.
But the key is it's quarantined. It doesn't infect the larger, prudently managed long-term portfolio. It acknowledges human nature rather than fighting it head-on, providing a controlled outlet.
And one last really innovative idea, leveraging psychology for good. Lottery-linked savings accounts. You might have heard of programs like Save to Win.
Where you get chances to win prizes for saving money.
Precisely. Instead of spending $5 on lottery tickets with terrible odds, you deposit $25 into a special savings account. That deposit not only builds your savings, but also gives you entries into drawings for cash prizes. Maybe small monthly prizes, maybe a large annual grand prize.
So it taps into that desire for excitement, the thrill of a potential windfall.
Exactly. But it redirects that impulse away from pure gambling, where you typically lose your principal, towards wealth accumulation. You get the fun of the lottery element, but your principal is safe and growing. It's a brilliant way to incentivize saving, especially for lower-income individuals who might be tempted by traditional lotteries.
Using behavioral nudges to make saving more appealing.
Right. By understanding and strategically applying these kinds of behavioral insights, you can essentially design your financial life to work with your inherent psychology, not constantly fight against it. You nudge yourself towards smarter, more beneficial decisions. Wow, we have covered a lot of ground today. We've taken a really deep dive into the fascinating, sometimes unsettling, psychology behind our investment decisions. From the Dunning-Kruger effect making us think we're investment geniuses when we're maybe just starting out, to all those other subtle biases, myopia, keeping us focused on the short term, representativeness making us chase trends, familiarity keeping us under-diversified, the disposition effect making us hold losers and sell winners. We've explored how both our genes, our nature, and our environment and learning our nurture shape our financial behavior. And then, maybe most importantly, we looked at the incredible really transformative power of behavioral financial education, especially its potential for younger investors like Gen Z navigating this complex digital world.
And that really is the core message, isn't it? The journey to becoming a more effective, more resilient investor. It isn't just about mastering spreadsheets or economic forecasts. It's profoundly about understanding yourself, your own mind, your own tendencies. And the solutions, the ways forward, they are genuinely accessible. They lie in cultivating self-awareness. They lie in seeking out targeted education that goes beyond just defining terms and actually tackles these biases head on. And they lie in the deliberate, consistent practice of strategies, like the ones we discussed, designed specifically to counter these inherent psychological traps. By truly understanding the quirks of human psychology, you're not just avoiding mistakes, you're actively empowering yourself to build a much more resilient and ultimately more rewarding financial future. It's about harnessing your own human nature for your own benefit.
So, as you reflect on everything we've discussed in this deep dive, here's a final provocative thought to maybe chew on. If even highly educated financial professionals, people with PhDs and decades of experience, can demonstrably fall prey to these subtle psychological biases, what tiny conscious shift could you make in your own daily financial habits, informed by these insights, that might create the most profound, positive, long-term impact for your future? Maybe, just maybe, the smartest investment you can ever make isn't in any particular stock or fund, but in truly understanding the workings of your own mind. We absolutely love exploring these complex topics with you here on The Deep Dive. Your engagement, your curiosity is what makes this community thrive. If this conversation resonated with you today, if it sparked some aha moments, please share your thoughts with us. Let us know what you think. Suggest future topics you'd like us to unpack together. And of course, if you haven't already, please subscribe to The Deep Dive wherever you get your podcasts so you don't miss our next exploration. Your engagement truly fuels these deep dives, helping us bring more valuable insights directly to you, our intellectual community. Until next time, keep digging, keep learning, and most importantly, keep asking those big, important questions.